this is the first rate hike we are seeing since July 2015, about 7 years or so. If you read the statement from the central bank, the inference being made there is that this decision is largely premised on inflationary pressures. The indication, therefore, is that this country is largely dealing with demand-driven inflation. Do you share that view?
Well, many thanks, Julian. Indeed, inflation has been on the rise, and it's likely that the central bank looked at other regions in Africa, Nigeria, South Africa, Egypt, which are sort of like moving in that direction. And to their effect, they, as you said, they have increased their interest rates. My worry is the type of inflation that you are trying to cure might not be the one that is present. What we have in Kenya is more of cost push inflation that is coming from the cost of inputs, which have been interrupted by imported goods, supply chain shocks. And normally monetary policy tools work best for demand-driven inflation, which is not the case. So the fact that we are trying to cure cost push inflation using interest rate tools worries me a lot, because it shows we might put the country into that situation called a stagflation, where economic activity is slowing down, but the cost of goods is still going up.
But Ken, allow me to play the devil's advocate here. We are in a very interesting scenario here. We have got the transition by banks into risk-based pricing. We still are not clear on how many have transitioned into that. So we can argue here, depending on how many banks are pricing their credit off the benchmark rate, then if majority are still in the rate cap regime, where it is basically flat at about 16%, you cannot argue that then credit flow will be stifled, don't you think?
Well, that's a good point, and I've actually talked about that in the past, where the transmission signal is weak, and many banks actually use other benchmarks like the 91-day or the 180-day T-bill sometimes as a benchmark. And to that effect, you could be right in the sense that historically, it's not really mattered much. In fact, we've seen instances where the hikes there have been lowering of the interest rates, but banks have not really lowered to that extent. So to that extent, I think I would agree with you that the transmission signal is low. But I think on the flip side, when Central Bank of Kenya raises its interest rates, commercial banks tend to act pretty quickly, because sometimes it's in their best interest, because they do have a profit motive, and they can easily explain it away to their clients that this is because of the central bank increment. So I agree that transmission signal is problematic and can be used either way. But I think there's something called the forward guidance. And I think the forward guidance that the CBK is trying to communicate is that the cost of credit should be a bit more expensive to slow down the sort of like the inflationary impacts on the economy.
Speaking about the forward guidance, Ken, do you foresee a situation whereby CBK could be getting itself into a rabbit's hole? And this is what I mean. So you tighten, hoping to contain inflation and inflation expectations. Because of the nature of the economy and the challenges in transmission, it doesn't work. And therefore, you are likely to get yourself into a tightening cycle without yielding the desired result. Do you see that as a potential risk in this environment?
I don't see it as a key risk factor, primarily because of what I said before, of that weak transmission signal. I think banks will just take their own view and continue. I think the biggest challenge would be sometimes when it comes to, as you say, the forward guidance policy, where everybody believes that the cost of credit has gone up. So even people don't even go to ask for those facilities, because they already know that they expect interest rates to be higher up.
Ken, let's talk a little bit about FX. We've been having a conversation around manufacturers decrying shortage of dollars in the market. The shilling on a year-to-date basis is about 3.3% down. To what extent do you think that informed this decision to try and woo the inflow of hard currency into this market, at least to alleviate some of the pressures that market players tell us they're facing?
Julian, I believe actually that might have been the biggest factor in this decision. If you look at how dollars have been leaving not just Kenya, but emerging markets, going back to the States because of those higher interest rates, you find most emerging markets are reacting by trying to raise, particularly countries that are net importers. And Kenya is one of those net importers, because when you're a net importing country, you're always exposed to imported inflation. And that imported inflation seeps into the economy. So the fact that we've seen the currency slide, absolutely, I do believe possibly that imported inflation possibly poses the greatest threat to the central bank right now. And I do believe that possibly was the greatest factor that possibly led to this decision.